Now the topic before us is the rise and fall of currencies, understanding currency appreciation and depreciation. Now we will understand the differences between currency appreciation and currency depreciation on various points. First is definition. What is the meaning of currency appreciation? Currency appreciation means increase in the value of domestic currency in relation to other currencies. Suppose we are living in India. Our Indian currency or Indian domestic currency is INR. All the other currencies except Indian rupee for an Indian citizen are foreign currencies. Suppose for some time I shift to USA, then my domestic currency will become US dollar. So now at present I am living in India and my domestic currency is Indian rupee and other currency say is US dollar. At present, if I want to purchase one US dollar, I will have to pay approximately 83 Indian rupee to get one US dollar. If there is currency appreciation, what it means? It means that I will have to pay less to get the same amount of other currency. Suppose if I have to pay 80 rupee to get one US dollar, it means that the value of Indian currency or the value of domestic currency has increased or the Indian currency has appreciated. On the other hand, currency depreciation means depreciation in the value of domestic currency relative to other currencies in the foreign exchange market. At present, we have to pay approximately 62 Indian rupee to get one Canadian dollar. We have to pay 62. Suppose if there is currency depreciation, that is the value of our Indian rupee depreciates, then we are taking simply example. We will have to pay more to get the same unit of Canadian dollar. Suppose we have to pay 65 rupee Indian rupee to get the same amount of other currency. If there is currency depreciation, suppose in this example we have assumed that the value of Indian currency has depreciated, that is we will have to pay the more currency in domestic currency to get the same amount of other currency. Now the topic before us is understanding currency erosion, devaluation versus depreciation. First difference we will understand on the point of definition. In case of devaluation, it is the deliberate or official reduction in the value of a currency relative to other currencies by the government or central bank. What it means? We are living in India and approximately 83 Indian rupee are equal to 1 US dollar. If the government or the central bank of India decides to reduce the value of the Indian currency, then it is devaluation. Suppose it decides that from now onwards 90 Indian rupee will be equal to 1 US dollar. It is devaluation. This decrease in the value of Indian rupee vis-a-vis other foreign currencies by the government order or by the order of the central bank of the country is devaluation of the currency. Here, external forces such as demand and supply, etc., are not the reason for the reduction in the value of the currency. The value of a domestic currency has decreased only by government order. This is devaluation. Official order is there to reduce the value of a currency. On the other hand, if the value of a currency depreciates in comparison to other currencies by the forces of demand and supply, then it is depreciation of the currency, where the market forces of demand and supply come into picture and the value of a currency decreases, it is depreciation. Exchange rate system. Devaluation occurs under a fixed exchange rate system. Fixed exchange rate system means where exchange rates are predetermined and the government intervenes to maintain that rate. We take the example, suppose if the government of a country decides, suppose a European Union, we are taking the example simply, that if European Union decides that 1 euro should be equal to 1 US dollar and it should remain somewhat as it is, and to maintain that balance it will be taking steps that the one value of 1 euro remains equal to 1 US dollars. So this is the fixed exchange rate system. So typically occurs under this devaluation occurs under a fixed exchange rate system where the exchange rates are predetermined and the government intervenes to maintain that rate. Suppose if the value of euro increases and the European Union is following fixed exchange rate system, suppose here 0.9 euro becomes equal to 1 US dollar. The government of the country may reduce the value of its currency to ensure that it again becomes equal to 1 euro is equal to 1 US dollar. Then depreciation. Depreciation of the currency occurs under a floating exchange rate system. When the demand of the currency falls, when the demand of anything in the market decreases, what happens? The price of that goods decreases. In the same way, in the foreign exchange market, when the demand of a currency decreases, the price of that currency also decreases. So this is the depreciation, and it occurs under a floating exchange rate system. Now, what is the cause of devaluation? The cause of devaluation may be government policy decision. The government of the country may have decided that it wants to make exports cheaper and imports more expensive, so that it may improve the trade balance. On the other hand, depreciation of the currency may be caused by the change in supply and demand of the currency, domestic currency. There may be negative outlook, economic outlook of the country, economic performance of the country is not good. There is political instability in the country, and the speculative investors also believe that the value of the currency is likely to depreciate in the near future, so they will offload their domestic currency. So it will result into the depreciation of the currency. Speed. Devaluation is a one-time exercise. The government may have decided that it wants to reduce 10% reduction in the value of the currency. It is a one-time decision. The government of the country may decide any percentage, 1%, 2%, 3%. And this is a one-time devaluation of the currency, one-time reduction in the value of the currency. This action has immediate impact. If suppose at present 80 Indian rupee are equal to 1 US dollar, and if the government of India decides that it wants to devalue its currency by 10%, then what will happen? Immediately 88 Indian rupee will become equal to 1 US dollar. Impact is immediate on the exchange rate. However, in the case of currency depreciation, the depreciation of the currency can be gradual or rapid depending on the underlying market forces. The impact of depreciation might not be as dramatic and immediate as the government driven devaluation. It means that in the case of devaluation, there was immediate reduction in the value of the currency. That is, if the government decides at this point, there will be immediate reduction in the value of the currency. But in the case of depreciation, the value of the currency depreciates slowly and slowly, or it may be rapid, but not as fast as happens in the case of devaluation of the currency, because in case of devaluation, it is by government order and it has immediate impact in the foreign exchange market. Now, appreciation of value. In the case of devaluation, it is possible for the government to raise the value of the currency after it has been devalued. It means that today the government decided to devalue its currency. Now, after some months, it decides to raise the value of its currency. It may do so. It may raise the value of the currency, but it is a very complex and challenging process to raise the value of the currency once it has been devalued. That is, if today 80 Indian rupee are equal to 1 US dollar and there was 10% reduction and 88 Indian rupee were equal to 1 US dollars. But after some months, the government decides to reinstate that original position. It wants to increase the value to 80 Indian rupee equal to 1 US dollar. It may not be as simple. It is not possible to increase the value of the currency in one shot. The devalue is simple. To increase the value is not as simple. It is a challenging process. In the case of depreciation, once the currency has depreciated, it is possible that it may appreciate, but this is not a guarantee. If there is political instability in the country, the foreigners are not interested to make investment in the country, then what will happen? There will be no demand of the domestic currency in the foreign exchange market. However, if the demand of the currency increases, the outlook of the country improves, economic performance improves, the investors think that it will be worthwhile to make investment in the country, the demand of the domestic currency will increase and the value of the domestic currency will increase. Next is control. In the case of devaluation, government has direct control over the timing. It may decide that it will devalue its currency tomorrow or next week or on a particular date. The government decides what is the timing of devaluation and what is the extent of devaluation, whether it wants 1% reduction, 2%, 3%, the government decides timing and percentage of extent of reduction in the value of the currency. Government decides. But in the case of depreciation, it is the demand and supply in the foreign exchange market which decides the depreciation. For a larger market forces mostly dictate the pace and extent of depreciation. That is, the demand and supply mostly decides what will be the depreciation, whether it will be fast, gradual, or what will be the extent of reduction in the value of the currency. With the government having limited direct intervention, that is, in case of depreciation of currency, the government has very little intervention, direct intervention. Now, the second point is impact on imports. In case of currency appreciation, imports become cheaper because the domestic currency has more purchasing power in the foreign markets. We will understand what we have said with the help of an example. Suppose USA company is importing shirts from France. USA company is importing shirts from France. What is the currency of France? Currency of France is Euro. What is the currency of USA? It is US dollar. Now we assume that cost of one shirt is equal to 100 euro. We also assume that 1.2 US dollar is equal to 1 euro. So at present, what is the cost of the shirt? At present, the cost of the shirt is 100 euro or 120 US dollar. That is, US company has to pay 120 US dollars to purchase one shirt from France, as they have to pay, will have to pay in euro, they will have to purchase euro, and 100 euro will cost them 120 US dollars. Suppose there is currency appreciation, that is the value of US dollar increases. So after appreciation, we assume 1 US dollar becomes equal to 1 euro after appreciation. That is the value of domestic currency of USA. That is, the US dollar has increased vis-a-vis other currencies. So after appreciation, 1 US dollar has become is equal to 1 euro. Now what is the cost of one shirt after appreciation? The cost of one shirt after appreciation is this, it will remain 100 euro. But in when converted into dollars, what is the present position? Here it is 100 US dollar is now equal to 100 euro. So the cost of shirt at present is 100 US dollar. So earlier the same US company was paying 120 US dollar or 100 euro to import the goods from, to import the shirts from France. Now after the appreciation of the domestic currency of US dollar, the US company is paying the same amount in euro, 100 euro, but as there is appreciation of US dollar, they have to pay less domestic currency. That is, instead of 120 US dollars, the US company is now paying only 100 US dollars to the France. That is, it is only same currency in foreign currency is paying same amount in foreign currency, but in domestic currency they are paying less. So imports have become cheaper for US people when they are importing goods from other country. Now we come to currency depreciation. In the case of currency depreciation, the value of domestic currency decreases. So imports become expensive because the domestic currency has now less purchasing power in the foreign market. Now we assume that cost of one shirt, we are importing, say India is importing shirts from USA. We assume India is importing shirts from USA. The cost of one shirt is 1 US dollar. At present, the value of 83 Indian rupee, it is 83.51 as on date of recording of this course, 83.51 paisa. We assume that it is approximately equal to 83 Indian rupee is equal to 1 US dollar. We assume that the cost, that when an Indian is importing a shirt from USA, it costs him 1 US dollar, or the Indian have to pay 83 rupee in Indian currency to import the said shirt. Suppose the value of Indian currency has depreciated. What it means? It means that the Indian people will have to pay more in domestic currencies. We assume that we, after depreciation, we have to pay 87 rupee, because 87 rupee has become equal to 1 US dollar. So after depreciation, we assume that 87 rupee Indian rupee has become equal to $1. So now the cost of one shirt is same $1, but we will have to pay more in Indian currency or more in domestic currency. So imports have become more expensive for the Indians when they are importing goods from USA. Or in other words, we can say that imports become expensive for the people of the resident of the country in which the currency has, in which the domestic currency has depreciated in value. Thanks for watching. If you like our course, please spare some time to give a star rating to our course.